Hello, chart watchers, and welcome to this Friday, December 7th, Market Watchers Live Show with your hosts, Tom Bowley and Mary Ellen McGonagle. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, yesterday's rally seems somewhat distant. As you can see, the Dow Jones Industrial Average currently down 420 points. The S&P 500 down 44. The NASDAQ down 148 points, more than 2% so far today. Russell 2000 hanging in on a relative basis, but down almost 14 points today. 10-year Treasury yield kind of flat from where we finished yesterday, but still what I would consider danger territory after breaking down below 3%. Money still rotating into Treasuries, not a good sign. Volatility index was down quite a bit earlier as the market started off in positive territory, but you can see a pretty big rebound today in the VIX as the market has been dropping. Currently, you can see it up at 22.6, which is still quite elevated. XLK technology leading to the downside, along with healthcare, the consumer discretionary space, and industrials, all down close to, or maybe even a little bit more than 2% today. Two worst performers in the S&P 500, both earnings related. Ulta Beauty currently down more than 10%, and Cooper Company, COO, down slightly less than 10% on the session. Both having difficult days. We'll talk a little bit about those earnings reports in the charts, along with a few others in just a bit. But first, let me welcome in my co-host, Mary Ellen. Welcome back. How are you doing today?
Oh, I'm doing quite well, thanks. How are you?
I am doing okay. I'm actually getting ready to take a trip out to Seattle, to the home office.
Oh, lovely.
Yeah, I'm very excited about coming out there, especially since we've got snow and ice moving into the southeast on Sunday. I want to get out of here before that hits.
And head up to Seattle. Beautiful city.
Yes, it is a beautiful city. I think every time I've been out there, it's been sunny. So I was looking at the extended forecast, and I think it looks like it's not going to be so sunny this time around.
Darn it. I hope you'll get to see, I don't know who's in town sports-wise or...
Yeah, actually, I am going to go out to the Monday Night Football game. Seattle.
Wonderful.
The Vikings, a really good game. I'm going to go out there with some of the folks at Stock Chart, so looking forward to that.
We'll look for you on TV?
Yeah.
You'll be the one paint it?
Yeah, I'll be the one in the Redskin jersey.
Oh, great. always the contrarian.
Yeah, exactly. You've got the Seahawks colors, got the blue and the green.
Right.
Got the Vikings purple. And then, of course, you're going to have this burgundy and gold person sitting right in the middle of the stands,
You know what? I don't usually come in on the show, but you're dissing my Hawks, man, and this is not okay. Coming in to diss my Hawks.
Uh-oh.
Wow. I think I struck a nerve.
You just struck a nerve, man. And not only that, I just looked up the weather, and it's sunny today and tomorrow until you come in on Sunday. So I don't know what to tell you.
Yeah, so I'm bringing in the Redskin jersey, and I'm bringing in the rain. Sorry, Zach.
I think your welcome caravan just faded a bit.
I'll let you get back to it. Bye.
Yeah, I can't believe you stepped in. I like it.
Well, you started talking about the Hawks, man.
I started talking a little smack. I know I might have my trip rescinded. I better.
Oh, that's funny.
Now, I will not wear my Redskin jersey. I promise. I am looking forward to it.
We'll see.
That should be fun. And by the way, Kirk Cousins, the Redskins' former quarterback, now quarterbacking the Vikings. But I promise I won't cheer there.
Should be quite a match.
Anyway, all right. Well, what do we got going today, Mary Ellen, and what's coming up?
Well, today is going to be busy as usual. We're going to go ahead and start out by looking at strategies that you can utilize to short the market, given the dynamics currently in place now. And actually, that is going to be next Monday, your workshop, Tom, shorting strategies. And then on Tuesday, Greg Morris is going to stop by. He's always a wonderful personality, has lots to add as far as his many years of experience. And then Bill Shelby is going to be in on the 13th next week. So pretty busy schedule there.
And then today, and by the way, Bill Shelby, when he comes on, has always got some pretty good tips about stock charts. We were kind of talking a little bit, and he might come in and talk some next week about scans and using scans for shorting, which, as you'll talk about in a minute, we're going to take a look at later today. But Bill always a great guest to have on here to talk about how you can better use the website here at Stock Charts.
Wonderful. Yeah. And then today, of course, we're going to do what's hot and what's not. And that's going to be in about 15 minutes. And then from there, 10 in 10, we'll be taking a look at those stocks that viewers would like to have us take a look at.
Mm-hmm.
And yeah, and then scanning for shorts. We will go ahead and do that later today, and that'll be expanded upon even further next week by Tom.
Yeah, and what we'll do in that final segment, we're going to take a look at, I'll show you a scan, and there's lots of different ways you can scan for shorting candidates. And I'm not convinced yet we're in a bear market, although I was talking about the jobs report to watch, and we did come up with a disappointing jobs report today. I'm not surprised the market reacting negatively to it, but we'll talk a little bit about scanning for shorts. And then Mary Ellen's going to give her take on some of those stocks, and should be kind of interesting because we might have some disagreements there. We'll have to wait and see. Mm-hmm. But yeah, let's go ahead and run into the economic reports today because, believe it or not, there were quite a few of them. The main one centering around the non-farm payrolls. This comes out the first Friday of every month. I look at it as the most important economic report out there. I think it's kind of like the earnings report for the stock market. You've got non-farm payrolls, and I've shown that chart before where the S&P 500 tends to be fine until we move up into the, until we run into an area where the job starts to roll over, the rate of change in job growth starts to roll over. Well, today it was lighter than expected. I'm not saying that this is, going to generate a bear market or going to take us into a bear market, but it certainly is one of those components that we need to be aware of. Anyhow, you can see November non-farm payrolls came in well below expectations, 155,000 versus the 190 expected. The private payrolls came in 161 versus 183,000. The November unemployment rate unchanged as expected, 3.7%. Average hourly earnings rose 0.2%, slightly below the expectation, so that'll help in terms of wage inflation. December consumer sentiment, though, came out a little bit later this morning, slightly above expectations, 97.5 versus 97.4. And then finally, 10 a.m. Eastern October, wholesale trade rose 0.8% versus the 0.7 that was expected. When we take a look at what's going on in the bond market, you can see the 10-year Treasury yield continues in this decline. I know currently today we're up slightly in the yield from where we closed yesterday, but after the huge drop, we're really seeing almost no bounce to the upside, and that's a little concerning. It kind of tells me maybe we're going to make another run for these lows that we saw back in May, June, July, August, down in the mid to upper 270s, maybe into to the low 280s. We saw a low yesterday down around 2.83%. Wouldn't be surprised to see another push back down there based on what's going on, and especially if the stock market keeps selling off. Some of that money may rotate into treasuries. And, of course, when treasury prices rise, the yields come down. So we want to keep an eye on this. I think we could be moving back down into the low 280s. We'll have to watch and see. All right, a number of earnings reports out, mostly last night. You can see those on your screen. And despite mostly better than expected earnings, you can see Cooper Companies came up short. But despite mostly better than expected earnings, not all the stocks reacted positively to those reports, and that's been part of the problem throughout this last 2 months. The earnings season is that even companies that are beating on their bottom line and top lines for the prior quarter are seeing some of their guidance being lowered in the next quarter or in next year, and that's really keeping a lid on the market. That's why we continue to consolidate. And so the big question remains, will we hold on to this consolidation period, this basing period on the major indices, or will we break down and perhaps move into that bear market that many here at Stock Charts are already calling for? All right, let's take a look at some of those earnings reports, though, as far as the charts go. The first one will be Broadcom. And you can see, let me just make sure I have the most recent price action here. Yeah, we had to gap up earlier today. And Broadcom did beat on the bottom line, as you saw earlier, 585 versus 558. But I didn't see any guidance going forward. Their top line was a little bit better than expected, so the stock gapped up. But this sideways consolidation, I'm not really going to be impressed until Broadcom can clear 250. Just earlier this week, actually, we had gotten up to about 247, 248. Couldn't clear that reaction high off the huge gap down we saw back in July. And so I think we're in a sideways trading range, 250 top side, maybe down around 210, 211 to the downside. We just saw a low yesterday at 217, and then today high of 239. I mean, literally the market's been all over the place, and mostly downside action, but we are still holding on to those key February lows in the overall market. Next stock up, Lululemon, LULU. This is a company that did beat on its top line, 747.7 million versus 736.1 million. It beat on the bottom line, like I was saying, provided inline guidance, and it's just not good enough right now. Stock down 8.5%, testing some recent lows down at the 117.5 to 120 area. Today's low got down to 118. We're trying to bounce off that level, but I don't know. We'll see whether or not we hold. This is a stock that with a decent earnings report, if you wanted to trade it off of support, I'd be fine with that, but just keep that stop tight, because if we break down below, sometimes what happens technically in the market, we're looking ahead at what's going to happen, not necessarily looking at what the report was that just came out for the last quarter. So always keep that in mind. Market looks ahead. ULTA, this is Alta, worst performer in the S&P 500. They matched estimates. Top line, 1.56 billion. They beat bottom line estimates, which they had raised earlier back in November. They beat those, came in at 218 versus 216. But here was the kicker. They lowered their Q4 revenue and earnings per share guidance. It wasn't a huge revision, but again, these companies that are higher growth companies, when you start lowering your estimates, the market makes you feel the pain. And you can see today, Alta down more than 10%. And there's a pretty good support area just below 265. That's where all the buyers have been over the past couple of months. If it doesn't hold, if you start seeing Alta trade down below 260, I think it could maybe fall all the way back down to that heavy volume gap up down around the 247, 248 area. So could still see some more downside, although we are at a near-term support level for Alta. COO, Cooper Companies, this is the second worst performer in the S&P 500, down 9.4%. You can see the gap down, continuing weakness. They did beat on their top line, but they missed on the bottom line. That was the only one on that slide I showed you earlier where we did have a miss. They lowered their fiscal year 19 revenue and EPS guidance. Watch the low that we saw in October. If that gives way, you could see a lot more selling coming in. And DocuSign was the fifth one that we had on the screen earlier. This was a company that beat top line, beat bottom line, raised their revenue guidance, gapped up slightly at the open, but you can see now down 4.6%, and it is still remaining in a downtrend. Be careful with this one. Last couple of smaller stocks that I'll go over real quick. AOBC, American Outdoor Brands, beat top line, beat bottom line, raised guidance, really nice push to the upside. I think this was a stock we talked about in the 10 and 10. I remember looking at this gap support, thinking it would hold. Of course, you never know going into earnings what's going to happen, but we did get that move to the upside. UNFI, United Natural Foods, big gap down. Look at this on a relative chart. UNFI has been moving lower for quite some time. Its industry group was actually setting a high in September, but United Natural Foods had been gapping down, had been really weak heading into that. So what you see is a stock that has been a very big underperformer amongst its peers and amongst the S&P 500, even though its peers overall have done well versus the S&P. So you've got a decent group, but you've got a really poor stock within it. And the market gives you signals. I mean, you didn't have to wait for today's report to know things weren't working out very well at UNFI. All you have to do is look at this chart and look at the relative performance. You really shouldn't have been expecting much out of this company. Last one I want to pull up is ZUMZ. You can see the downtrend here, even though the apparel retailers had been moving higher. And so on a relative basis, this was a stock that was really struggling. They beat their top line, beat their bottom line, but once again, lowered their Q4 revenue and earnings per share guidance. But it's been going down for 3 months. So the technicals have been telling us this all along. Last chart I'll show you before I turn it over to Mary Ellen. The S&P 500 in my blog this morning, one of the things I was looking at on the hourly chart, When you're breaking down on this kind of increase in volume, usually that test of that declining 20-hour EMA is a problem. So I was looking at 2705. We got to 2708 today. Reversed, came right back down, and you can see some of that selling kick back in. If we lose 2630 or so on the S&P, I believe we're going to go back and test that February low at 2582. And that is going to be where the rubber meets the road. We'll see what's going on in this market, whether we're in a correction or a bear market. All right, if we do move into a bear market, Mary Ellen, I know a lot of folks just like to stay, a little safer, maybe with some of the dividend stocks. What do you have for us today?
You bet. Yeah, we are going to be taking a look at defensive plays here, given the current market dynamics. And what I'm going to do here is initially show you from stockcharts.com. This is a view of the weekly performance of the S&P sectors. And quite clearly, you can see the utilities sector fund, XLU, is one of the only ones that is up today. Of course, real estate sector fund is up slightly as well. So I'm going to start out by showing you how you can use this interface to point you directly toward utility stocks that you could potentially take a look at. A lot of them are going to have these higher yields. But then from there, mainly, I'm going to be focusing on some utility select sector funds. But let's go ahead very quickly and take a look at the utility underlying listing here, and you can see currently gas distribution is the best performer. For my work, I like to go to the larger one as far as seeking out possible candidates, and from there you can go ahead and use this Scooter SCTR ranking, and the higher the better. This is a technically driven, but it is a longer term horizon, and this is going to get you in front of those better performers immediately. So that AWK and then so on down the line, that yields 1.9%. So that is one way that you can get in front of these the utility stocks individually. For those of you that are not inclined, you're not familiar with utilities, what drives their uptrends, you can of course take a look at some utility, as I said, select sector spider funds. And these are also going to provide you with a yield. So let's go ahead and get started. The first one we'll look at, its ticker is XLU. And this particular fund is the Utilities Select Sector Spider Fund. And that is the biggest, certainly most well-known sector fund for utilities. This provides you with a 3.2% yield, and you can see quite clearly it's in an uptrend here. It's trading above this 10-day simple moving average, which is also trending positively. Your RSI is positive, as is your MACD. The next one we can take a look at is IDU. That's the ticker symbol. And this is a Dow Jones utility fund. Now, the other thing you're going to want to pay attention to with these ETFs is their expense ratios. They will dig directly into your potential return. So that XLU had a 0.13, very low expense fund. This particular IDU has a 0.43, so almost a half of a percentage point on the expense that, again, is going to impact. But you can see that uptrend very, very similar to XLU. Let's take a look at Vanguard. VPU is the ticker on that one. And this particular fund, if you take a look at all of these, do tend to have that similar dynamic with the RSI up here above this net neutral zero in an uptrend, and the MACD positive crossover also above zero. So this VPU, all of these are going to be configured a little bit differently. The Vanguard Utilities uses the 2550 Investable Market Utilities Index, and it includes companies that distribute electricity, water, or gas, and they operate as independent power producers. So it has 3.4 billion. You also want to look at liquidity. You want to make sure those ETFs that you're investing in are active on a daily basis. So a $3.4 billion AUM is really quite constructive. Let's take a look. We have time to look at one other, FUTY. And there are others as well. This is Fidelity's MSCI Utilities Index, and they offer a 3% yield. And I didn't mention, I apologize, that Vanguard VPU also offered a 3% yield. But FUTY is not quite as liquid, but their expenses are super low, 0.08. They do have about 500 million, a half a billion in AUM. And then one last one, also with a 3% yield, RYU. This is Invesco's S&P equal weight utilities, a little lower on the AUM, about 300 million. And you can see that the RSI is positive. It's trading generally in an uptrend. Your MACD has that positive crossover above that. And I believe I am a bit out of time. I had some alternative energy stocks that are looking quite constructive, as well as dividend growth ETFs. But let's take a look at just one alternative energy to give you a sense of what's offered there. PEGI, it's an 8% yielder. They do wind and solar. They sell most of its power by way of long-term contracts, and they're expected to report their first full year of positive earnings. And we can see that the stock is, again, RSI positive, as well as that MACD. You can drill down into the alternative energy space. There's TERP, yields 6.6%, KEN 11.8%. We don't have time to go through them, but it certainly is an area, a viable alternative area for you to look at for yield candidates, because this is an area of the markets that are not as impacted by trade wars and higher interest rates and some of the other fears that are out there.
Yeah, I think, I was looking at that PEGI, and it's listed under conventional electricity. Some might be looking at that thinking that maybe it moves along with oil prices. Of course, oil prices have been hit so hard, but that is considered part of the utility space, which has been pretty strong of late. And as you showed, I mean, it's breaking out. Even though the market's been very weak, there are still pockets of strength out there for sure. And this is an example of one of those, no doubt. All right, we are going to move over into the what's hot and what's not. Mary Ellen, you and I were joking before the show.
Yes.
That, literally what's hot yesterday afternoon is what's not today. I mean, the volatility, it's really hard to do this segment over the course of the last week, because what you have during one part of the week completely changes by the latter part of the week. But we're going to go ahead and do it anyway. I know you had some interesting stocks in the software space. Why don't you start off with software?
Yeah, you're absolutely right. Software stocks, that's for me, a really interesting area of the broader markets. When you were to look at technology going into the summer months, coming out of that correction last February, software stocks really led the way. And a lot of the underlying subgroupings there had moves in the 40% range. So to see them come back this week prior to today's action was really quite encouraging. And let's take a look. I can show you for instance, there are several ETFs here that cover software stocks. And one of the things with software stocks, this is not quite as compelling again as perhaps before, but this is HACK. This is a cybersecurity software ETF, but we can drill down and take a look at a name in that space, CYBR. This is a smaller cap stock. It's CyberArk software. But before we dig in, I was going to mention that for many years, software stocks were viewed as somewhat defensive in the sense that their revenue source is built out by contracts, and these contracts provide them with very consistent, the software companies with very consistent income, whether it's monthly, annual. So when you sign up for these cloud software providers, you are then in essence paying these companies on a very regular basis. So because of that, oftentimes for years they were viewed as defensive. Not so this time around. These software stocks did start getting hit. Let me just go ahead and drill down a little here to provide you with some dates. And it really was in September that a lot of the software stocks, prior to the October correction in the broader markets, these guys started to fall out of bed. But let's take a look at this week and some of the stronger stocks in here. So I talked about cybersecurity. This is CYBR, and security related stocks within the artificial intelligence space. This is a very hot area, cyber computer security. A lot of venture capital firms are throwing money at the space. And then a lot of the bigger firms, Amazon, Microsoft, Google, they're buying artificial intelligence startups as well. And Google even started their own subsidiary, and this is all related to security, the potential for hackers to come in and compromise data. So the threat is real, it's out there, and so as more and more companies migrate their data to the cloud, there's a lot more in the way that can be attacked. So CYBR is one. This particular company provides an extra IT layer for privileged data. They currently work with half of the Fortune 500 companies out there. It's currently trading at 74. We can see the RSI is positive. Your MACD is trending positively. It does have a $90 price target by one of the Wall Street firms. And let's go ahead and take a look and move on to another security, computer security related stock. And this next one is FTNT. And this particular company is, you can see also the RSI up here. It's trying to trend positively. We're not quite there. It's getting met with a little bit of resistance at this net neutral. So we're not also out of the woods with the MACD. We did have that MACD positive crossover, black line through the red. We want it to get up above this 0 before we turn truly constructive on the stock. And then lastly, taking a look at the position of the stock relative to its simple moving averages. If those two technical signals coincide with a move back above this 50-day simple moving average, FTNT certainly would be a buy. They just came out with a report that they've expanded their security offerings with Amazon's web service, AWS, and that's huge news. So we'll keep this one on the watch list for potentially turning. Moving our eyes elsewhere in software, some of these software gaming stocks have been picking up, but I will tell you they are mostly Chinese, originating out of China, and China's market is trying to get off the mat, if you will. They were in bear market territory, but let's take a look at Sohu, SOHU. We can see this downtrend reversal occurring right now. The RSI is above this net dash neutral, trending upward. MACD also trending upward and above this 0 line. Take a look at how the stock is trading above this upward trending 10-day simple moving average. That's the green line. It already broke up above this red 50-day simple moving average. So from here, we could potentially have a move from 22 up to about 28, which is your 200-day simple moving average. And from there, you are going to want to keep an eye and make sure that it's able to break back above that and continue its potential uptrend. And then one other Chinese gaming stock is NTES. See if I can pull this one up. This is NetEase. NTES is the ticker symbol. And we can see that this particular stock in a similar fashion is still attempting to completely reverse this downtrend. So here we are at this 200-day simple moving average, which is acting currently as resistance. So a break back above that, coinciding with an RSI that's positive, as well as a MACD, would certainly set this one free, so to speak. Software enterprise is a huge space in this market, and I'm going to see if I can cherry pick some of the better looking names, because I do have a host in this space that really had a good week going into today. This is ALRM, Alarm Holdings. And we can see that this stock also has those positive characteristics that I've been pointing out, with that RSI trending up above the net neutral, MACD just now getting up above 0. And now we have the stock above all of these key simple moving averages, and your shorter term 10-day is in an uptrend. And that, of course, is constructive. Let's take a look at another name. TWLO is Twilio. And this particular stock we can see really held in well despite the correction, not only in the broader markets, but also in software stocks. And this particular company, they handle the texting and calls and video from mobile apps. And one of their bigger customers is Facebook. The company came out, their last quarter revenues were up almost 70%, and their earnings are being revised upward. For next year, revenues, they're looking at 2019, 31%, 46% in earnings. So super growth there. RSI is trending upward, as is the MACD. And then one other area in here, as far as software enterprise, is NOW. This is ServiceNow. And this particular company, they provide workflow automation and performance analytics. We can see that the stock also has that RSEI. It's up above this net neutral, but ideally we would want it to continue to trend upward. This current action here implies that it may be stalling a little following this extensive move from 145 to 190. Certainly expect it, but outside of that, your MACD is above the zero and you're above these key simple moving averages. And one other, actually, we can move on from these computer software stocks and take a look at another area that's been hot this week, and that would be internet retailers. And in a surprising move, because it's been a mixed bag, certainly within retailers, but let's take a look at certainly the largest name in this internet retail space, and that's Amazon. Unfortunately, it is giving back a bit of its move for this week. It's down 2.5% today. So really what I'm seeing is a stock that is battling around this 200-day simple moving average, because we talked about that this moving average is going to be a provider of a long-term outlook. As the stock breaks below the 200, it's a much heavier pattern. It's going to require more work as far as trending and eventually turning positive. We're looking at a daily chart with all of these, and you can see the MACD is trending upward, but not quite up above that net neutral zero. So we have a lot of positive potential in Amazon, but at this juncture, it does still seem to be battling, if you will, around that 200-day simple moving average. Let's take a look at another internet retail stock, and this one is Etsy. For those of you not familiar, this is a platform, software platform that allows craft providers to sell their goods, and it's really beloved by Wall Street. And a couple of items that happened here. This is their earnings release here, super strong. They also came out with news that they increased their fees to those users that use their platform up to 5%. That's been a big boost to their revenue. The company's been using that money to upgrade their software. The users of their service are very highly charged and continue to do so. We can see that the RSI is trending upward. The stock's actually poised to break out to a new high, and given the current market conditions, that's very, very strong, constructive. We can see that the MACD is trending upward as well. And then one other name that we can take a look at in these internet retailers that is coming out after being really beaten down by the broader markets. This is Wayfair. Ticker symbol is W. They are a home furnishings online provider of home furnishings. And you can see that the stock really fell out of bed. This is that October into November correction within the broader markets. So the stock really got beaten down. This is a 50% decline in the stock. So certainly do a potential bounce, and it's doing just that, but it's finding resistance at this downward trending 50-day simple moving average right now. But the RSI did turn positive. As cited before, it is trending a bit sideways, so we may be digesting this move from 75 up to 110, which was quite significant. MACD poised to trend positive. And one last one that we can take a look at, but I did want to talk also about Wayfair. The company's expanding. They're going to be adding 1,000 new jobs, and they are viewed as an outperform by analysts with a price target of 143. So we're at 110 now. If it's able to get back up above that 50-day simple moving average, we should be in better standing. And then we'll have a few seconds here to take a quick look at internet content. And I'm just going to cover a couple of names here so we can move on within internet content. Twitter is a stock that has had a good week. The company estimates are being revised upward for this year, 82% on the earnings growth. This also has a price target of 39. The stock's currently at 33, and the RSI and the MACD are both positive. So let's go ahead and move on to another area that's been hot this week, and that has been REITs. And I'm going to focus today on residential REITs and two stocks in particular. The first one is ticker symbol SUI, and this particular company is, see if we can pull that up. It's called Sun Communities, and what's happening within a particular area of residential REITs. Take a look at this big move here. There's been increased interest. This is a company, and I'll show you one other one, that does manufactured housing parks. And years ago, they were called trailer parks, but now they've upgraded that and the concept of it as well. These are more like resorts. They are really attractive to baby boomers. Over 40% of baby boomers have seen or will see a quality of life drop after they retire. 1 in 3 retirees have zero money saved. 1 in 6 only have 10,000 saved for retirement. So these alternatives, manufactured housing alternatives, the price for these homes average around $30,000. And again, they are more like resorts. They have putting greens, pools, and so forth. So SUI is one that's in that space. It offers a 2.6% yield, and it's about a $9 billion company. And then ELS is in the similar space. This particular company offers a 2.1% yield. And you can see it's very, very positive as far as breaking out, hitting a new high, trending above that upward trending 10-day simple moving average. Your MACD has this positive upward crossover as well. So I did want to point that hot area out. And so let's go ahead and review what's not. I'm sure we can throw a lot into this basket, but what I wanted to really focus on is financials.
Hey,
They've got, oh yeah, go ahead, Tom.
Sorry, can I have you look at one other stock? I know when you were talking about security stocks earlier, there was one that kind of had gotten my attention, and it had opened. I think its offering price, or maybe just where it opened back in 2013, was around $20. It went way up above that, came back down below, and is now just coming back up above 20. It's FireEye.
Oh yeah.
And just looked kind of interesting, and it was kind of in that same space that you were talking about earlier. So I thought, what do you think of FireEye at this?
Yeah, that actually was on my list, and it is very constructive looking again, because when you see the broader markets go into a correction and go into a negative period or phase, and you have a stock that is able to buck that downward pressure that's occurring absolutely everywhere else, that is a sign of very, very clear-cut strength. And the primary point there is that if the market pressures go away, these stocks are going to be your leaders. So this is another stock. It's poised to break out of this V-shaped 1-month base. Your RSI is positive, and your MACD is positive as well. It's up above that 0. So that is actually a very good example of yet another strong stock within that computer software security space. So yeah, that looks quite good.
Yeah, I didn't mean to interrupt you. I just know that was one that I had seen before we started the show, and I knew you were going to be talking about that area, and so just wanted to point that one out. It's pretty constructive because it did close yesterday. Now I know today, and this is what we talked about earlier as well, the up and down nature of the market right now. But yesterday's close was the highest close the stock has seen since the beginning of 2016.
Wow.
So pretty interesting when you consider what the market's been doing.
Very constructive, yeah. And as cited, this particular area within computer software is currently very, very strong, with a very positive outlook, because the need to be able to counterattack any potential attacks is going to be critical with all of the important data that's now being stored with cloud computing.
All right. Well, I know one of the areas. I'm sure you're going to go right into it. With the 10-year Treasury yield dropping, you got the whole yield curve. People talking about maybe an inversion of that yield curve, and some of the depending on what time frames you're looking at, some already have inverted. But bank stocks are getting absolutely hammered. Do you see any hope there?
Yeah, you're right. They really are getting hit. And so what we can take a look at really quite quickly is a bank ETF that is for regional banks, KRE. Let's take a quick look at that to give you a sense of just how much damage has been done. And take a look at this. This is in line with the broader market's correction, but really financial stocks have struggled throughout the year. And so financial stocks, particularly banks, we're looking at the regional banking ETF. These bank stocks, they will make their profits based on what's called the yield curve and the spread between longer term and shorter term interest rates. So what they do is they lend using the higher longer term rate, and then they borrow using the lower shorter term. So here's what we're looking at from stockcharts.com quite quickly. This is on the left side, the yield curve. I'm taking us back to 2011 because I want to show you what a normalized yield curve looks like. So the 3-month is represented over here. So down on the bottom quartile, we have the length of time, whether it's a treasury bond or a note. And then on the left side, we have the yields. So the 3-month treasury bill was right around a little around 1%, and the 2-year tends to go up. But as we get out to the 10-year treasury bond, the yield is at about 2.7. And then even out further, the 20-year, it gets up to that 3.2, and then it levels off a bit. But this is a very normalized sloped yield curve. The further out you go with the maturity, the higher the yield you're going to get. So what I'm going to do here on the right hand side is go ahead and take us to where we are now and take a look at the very clear-cut difference. This is a super flat yield curve. In other words, you're not being paid to go out and buy a 30-year. You're getting paid the same with a 2-year treasury note. And the reason, again, the significance there is that these banks will lend out at this higher rate. Let's say it's at about 2.5, and then they will borrow at this lower rate. Well, there's no spread. And that spread, if you go back again to a period that's a little more steep, you can see there the difference here as far as from a 2-year at about 1.5% versus 3%. So you're looking at a really healthy spread. We're not having that there now. So that is why these bank stocks are suffering. And so let's go ahead and dig right in and take a look at particular areas within these banking stocks. So I showed you KRE, XLF, KBWR is yet another regional banking. It's KBW regional banking ETF. We can see this fall off off the cliff, so to speak. An attempt at rally, super encouraging. But then last Wednesday, we had a very notable inversion, a very brief but very, very damaging inversion of that yield curve where shorter term rates were higher than longer term. Panicked investors sold their financial and in particular banking stocks. And here's an example of a bank. EWBC is the largest holding within KBWR, that ETF we were just looking at, and you can see it's just getting demolished. So until we see the yield curve extend and have any kind of slope to it, these bank stocks are going to continue to suffer. And there's also the outlook for continued, the housing market is dropping, so the demand for loans for housing is expected to drop off. So these bank stocks have a lot of headwinds ahead of them. Let's take a look at other areas within financials that are getting hit, and that would be the asset managers. We're looking at a market, the year-to-date indices that are negative, and so the performance of some of these underlying mutual funds are going to get hit. This is AllianceBernstein, AB. You can see this big gap down this week. It's trying to recover from that, but AllianceBernstein does have a lot in the way of fixed income funds. So when you see that flat yield curve and inability to provide performance to their clients, PNZA is another asset management firm. And let's see if I can get that ticker symbol in here properly. And it is not, so I might not be able to share this beautiful stock with you, but there certainly are any number of examples of these asset managers that are in these downtrends and may very well continue to struggle. And other areas within, not necessarily asset management, but let's take a look at a TD Ameritrade, and the ticker for that is AMTD. And there's an anticipation, Charles Schwab, E-Trade, a lot of these are back in downtrends after attempted reversals from this correction. And this is another area that will suffer if the markets continue to deteriorate. You're going to see more and more self-directed investors licking their wounds, not quite as active in their trading. So you are seeing a sell-off in some of these stocks as well. Let's move on to another area that's not hot this week, and that would be transportation stocks. So what we can do easily to get a handle on that is go ahead. In fact, I'll go ahead over here and show you how you can pull up the Dow Jones Transportation Index, and its ticker symbol is $TRAN, and take a look at really just how hardly hit these transports are. And this is certainly concerning because for those of you familiar with the Dow Jones Transportation Theory, we can see it's down now 7%. I just pulled up a weekly chart. The transportation stocks, generally you do want them to be in an uptrend because that implies a strengthening and a strong economy. You'll see rail stocks, freight movers all doing well because purchased goods need to be transported. So a weakening in transportation stocks is generally not a good sign. So let's go ahead and drill down from here. We can take a look at some of the stocks that are not doing well within it. And just as a sampling, I'd be better served to go ahead and use the interface here from stockcharts.com. We can then go into the sector summary, and from there take a look at the industrial stocks, and you will see through the week this weakness in these transports. Rail stocks down 4%. We can also see that aerospace stocks, but trucking stocks are down 6% this week. Airline stocks 8%, and some of that is going to be these freight forwarder stocks that are getting hit as well, which is not a good sign going into the holiday season. Let's take a look at FedEx. This is FDX is the ticker symbol. We're looking at a daily price chart. You can see the RSI trending down, the MACD going lower. So really not good happenings within the transports, and then also the transportation logistics. There are companies that provide logistics services as far as transporting, helping these companies figure out how to transport those goods. This is a prime example, ECHO. This is Echo Global Logistics, and you can see it's just falling out of bed. Another area is the equipment manufacturing for these transportation stocks, and we can pull up a prime example here is RAIL. This is a freight car, and really just not doing well on any level, but getting hit particularly hard this week. And then I do have a minute left here.
What do you make? I'm sorry, but what do you make when you see something like a rail where it looked like it was breaking out and it was doing great back just a few months ago, 3-4 months ago?
Right.
It loses more than 50% of the company's value in 4 months. I think that's saying something about what the market is anticipating about our economy going forward, isn't it?
Yeah, absolutely. This particular company is a transportation. They're an equipment manufacturer. I probably picked the worst of the bunch because these guys are negative all the way, negative earnings, poor outlook, poor earnings reports. So I can certainly pull up another example, but it's not going to be particularly healthy looking. ARII is another stock in this space that got bought out, of course. We can look at another example. But yes, so that really, this is WAB, and it doesn't look a whole lot healthier. It also came up from 112 and down to 85, so significant declines. And it's telling you that the demand for their services as far as their manufacturing, there's not going to be growth or expansion within the rail space. And this particular company has very healthy earnings, double digit for this year and next, but it's just being thrown out. So you can see where it had this attempt at reversal. And you remember the Dow Jones Transportation Index really looked poised to come back, and it was super exciting, and now falling out of bed. So yeah, I would say if you are a believer of that Dow Jones Transportation, the Dow theory is what it's called, to see these stocks deteriorating and getting hit is not positive. It's telling us that investors believe that the economy is contracting instead of expanding.
Yeah, on this particular chart too, I think there was a lot of warning signs after that double top printed in August and September. We came back down with that big red candle with the heavy volume and established a neckline that if you go over back to June, the low in June kind of coincided.
You bet.
Neckline there. And off of that right side of the neckline where that huge volume selling took place, we had that last little bounce back up to the upside and then right shoulder. And then we completely fell apart. It looks like it's probably made its measurement at this point down close to 80 back at the end of October. But yeah, I agree. This is not really painting a great picture at this point.
No, not what you want to see.
All right. Was that all you had for?
Well, the other areas where we can touch upon, they were just consulting stocks and staffing stocks, and they have everything to do with the outlook for corporate spending being declining. So a lot of these these companies that consult with corporations, their stocks are down 6-7%. Staffing stocks down 8%. So all of this with an eye toward the outlook not being particularly bright for these corporations, getting a sense that they're going to be pulling their purse strings in.
Yeah, and I would mention also, I know you mentioned the transports had been, weak, but the airlines within the transports up until this week had been pretty strong. And of course, crude oil prices were behind a lot of that advance. Crude oil prices were tumbling, and that's a key, expense item on looking at airlines. But the last 4 days, the airlines index has fallen from about 294 down to 265. So we're talking about a 10% drop here over the last 3 days. And that is adding to what already was a pretty weak area of transportation. Anyhow, all right, well, let's get on. We're going to move into our 10 in 10. And the focus of these 10 in 10 stocks is really, when you look at these 10 in 10 stocks, you're probably going to think, these charts don't look that bad. I mean, some of them I think actually look pretty good. And most of them are, actually, I think all of them are in more defensive areas of the market. So let's go ahead and start with Boston Scientific. And first, I just want to make sure, Mary Ellen, this chart is coming up on my screen. Can you see BSX and the annotations?
I can see it. We're good.
All right, just want to make sure it was coming across.
You bet. Very good.
Okay, so going back, I pulled up a weekly chart just to show you that BSX, if you connect these lows all the way back from end of 2014 when we really started a nice advance here, and you connect these lows coming across, that trend line currently intersects at about $31, $32. And our recent breakout above the October 2017 high was around 30. And then the selling that we saw just a couple of weeks ago went down to about 32. So I'm going to use this price support area around 30, 32 on BSX. And that also is where the trend line is. Now, currently, the stock's trading at 35. We do see that the PPO is rolling over and is, moving back down towards the center line. I think if the stock were to go back and get a double bottom down around 32 over the course of the next few weeks, I mean, especially if the market continues to be weak, we could certainly see that. And I would think the 30 to 32 area would be a very strong area for Boston Scientific going forward. But I know we got some other...
yeah, let's take a look at how about EXR.
All right, let's pull up EXR. And I'm going to pull these up using that relative chart because what I think this will point out is that when you start looking at these stocks relative to not just their own group, but relative to the S&P 500, EXR just made a relative breakout in 2018. In other words, it is trading relative to the S&P 500 at its highest level currently. So we've gotten up, had a basically double top. Maybe we'll pull back from this resistance area, but overall, I think this is a really nice, as you say, Mary Ellen, constructive looking chart, and it's in a space where we have seen some nice outperformance recently. So I would be looking at overhead resistance first at the high that we saw back in June. So we almost got there. Maybe this pushes us up there, but we are a little overbought. I think on the way back down, we just broke out above this 96 area. I think the rising 20-day, which has been holding as pretty good support. I think if EXR were to pull back into that 96 area, that would be interesting. But a lot of these charts, and I know this is just one example, but a number of these charts that we look at, you're going to see uptrends in play as opposed to a lot of the downtrends and things that we've been talking about with the market being so weak.
Okay, AVB is the next one.
All right, Avalon Bay. All right, again, against the relative chart, you can see another breakout. Notice that these pullbacks have been coming back down into, say, the 182.5 to 183, 184 area. So I think you've got some pretty solid support there. When you take a look at these charts, and this is what we talk about, if you're going to be in the market, you want to be in areas of the market that are performing well, and then stocks within those areas that are performing well. And the way when you view this on a relative chart basis like this, you see them moving up from left to right in terms of absolute price. Also, their group is moving up from left to right. This is their peers. And then you take a look at the stock relative to its peers moving up, the stock relative to the S&P moving up, and its peers relative to the S&P moving up. So that's how you outperform the S&P 500 without a doubt. And the fact that it is in the real estate area where you've got some nice support from money rotating into defensive areas, I think it creates some pretty solid support here for Avalon Bay Communities between about 182.5, 184. Pull back into that area, I think, is strong. Look at the volume trends. Certainly on the move higher with volume supporting it. So pull back into that 182.5, 184 area, I think would be a strong reward to risk entry into the stock.
Okay, MKC is the next one.
Yeah, McCormick. I love McCormick. I love their spices. And the stock, I think, from a technical perspective, has been on a roll. Again, you look at this chart and you think, what bear market or what correction? This group, this area, and especially this stock has been in favor for quite some time. Great volume trends. We got a really nice uptrend in play, and it's not even in a group that's been performing that well. So what you have is one of the leaders within the food area. And if I annotate this, I would be keeping an eye on the channel that it has been in. And one way you can draw a channel is first to draw your uptrend line connecting the lows, and then clicking the command and the left clicker here, you can kind of drag that same sloped line over. And you can see we didn't have quite an exact touch, but I think when you look at this, clearly the stock is channeling higher. And so as you get closer to the lower end of the channel, that typically is going to be the best area in terms of reward to risk. And notice the recent low is right over here close to that trend line. So if we were to pull back $5-6 from the current price, market's weak, and we see a little weakness here in this stock, I think McCormick would be an interesting buy at that level.
Okay, and then we have CVS.
All right, a drug retailer.
Mm-hmm.
And the drug retailers did have a negative divergence in play recently. So this high on the DJUSRD was accompanied by a lower PPO. I wrote about it earlier this week. I was thinking we might get back down to that 1,050 area. And if we do, some of these drug retailers could come into play as some pretty decent buys. But if we annotate here on the chart, I think we're already at a key short-term support area on the CVS. Here you can see the resistance trying to get through about 81.25 was tough. Couldn't do it. Now we've come back to this recent low. If we close below 74, I think there's a chance that we could go back to that prior low. And I think that's the biggest support area on the chart, because I think this is your reaction low after this uptrend. So you got a nice move higher, pull back on some pretty heavy volume. The buyers come in, we go to a new high. You don't want to start establishing lower lows. So as long as we hold 70, I'm okay in the longer term with CVS.
Okay, we have a utility, DTE.
All right, DTE. And of course, I can imagine that's a pretty nice looking chart. Many of these stocks, by the way, have high scooter ranks because they are in strong areas of the market. You can see a beautiful move up, pull back. We hold that rising 20-day. Now we're just kind of consolidating. Haven't been able to get the breakout, but again, you get a group that's been strong. The stock relative to the group has been strong, and the stock relative to the S&P and the group relative to the S&P. So all of this lines up pretty nicely, and as long as that last low right there around 116, 117 holds, I think we're in pretty good shape. Meantime, I think we're just sideways consolidating. The thing to keep in mind when you're trading these kinds of stocks is you're not trading software. You're not trading high volatility. If I was trading, I'd be looking for much smaller gains in terms of percentages. A 4 or 5% move in a stock like this is similar to maybe a 10 or 12% move in some of the more volatile areas. So you have to trade recognizing the type of volatility that those the stocks that you trade have. And in this case, DTE is not a particularly volatile stock, but I do think that move back down to that 116, 117 area still presents a nice opportunity for a short-term trade.
Great. And then Eli Lilly, LLY.
Yeah, the pharmas typically are defensive. They carry nice dividends. I know you were speaking about dividend stocks earlier and dividend ETFs and so forth. Most of these pharmas carry pretty nice dividends. And so a lot of folks, when they're looking for safety, when the market is so volatile, that's one of the reasons why you will see money rotating in to a group like the pharmas. And again, look at the relative strength and these charts. They're all moving up from left to right. So you know that you've got a really strong area. I'm going to pull my chart down just for 1 second so you can see these indicators and how they're set up so that you can duplicate this on your own charts if you're interested. But let's annotate this. And once again, I'm going to look at this from a trend line perspective because it looks to me like we've got a pretty reliable trend line. A trend line, you know, if you connect just 2 points on a trend line, and I'll erase this one, but if you're just connecting 2 points and you're just saying, okay, here's a, oh, that's not a very good line there. But if we just said, okay, this is the trend line, it's broken, we're in trouble. Well, not really. I mean, you're only connecting this point here with this up here. But when you start talking about connecting trend lines with multiple points along that line, that's a much more significant trend line, in my opinion. So you've got recent lows in terms of price support that come in, I'm going to say around 109, and then more recently at about 111. And notice the trend line comes in at about 111. So this Eli Lilly was trading up at about 120 earlier this week. Now it's trading for 113. As it gets down closer to the support area, if it gets back down there, I think your reward to risk on a trade on a stock like this really begins to increase. So I like Lilly.
Oh, good. You have another one, pharma coming up, MRK.
All right, Merck, this is another high scooter ranked pharma. And you can see from the chart why. It's a really nice looking chart. I'll just highlight again, it's the same as Lilly. So you can see the similarities here on the relative chart. But let's annotate and let's just draw some price support in here. There was a key top. We pulled back, held the 20-day. We broke out. But I'm also going to go to this most recent low down here. I think the 73.5 to 76 area is pretty good support. Once again, Merck, just a few days ago, was trading over 80. And if you look back, each time we have a pullback during this uptrend, turns out to be a pretty good entry point. We're working on a downtrend here in the short term right now. Again, 74, 76 area looks pretty enticing to me.
Then we have HOLX.
All right, that is Hologic. All right, and this is in the medical supply area. Medical supplies have been going down, but look at what this stock's been doing. It's actually been moving higher. So you don't have one of the better areas of the market, but you probably have one of the best stocks within the group. Look at the relative strength over the past 3 months versus medical supplies. And even with the group moving down, the stock has wildly outperformed the S&P 500. So that tells me you got a pretty good stock. I think this pullback to the 20-day moving average is interesting because it also is where we just recently broke out from. So let's annotate that price support level. And you'll see that we came back down and tested. This was the close. We pulled back. We broke out. Volume was okay on that breakout. Well, one day it looks like it was pretty good. But we have pulled back off of that bearish engulfing candle. And I think we're testing price support in the 20-day moving average. So HOLX, you look across here and it's held up pretty well. Going back to earlier in the year, we're near highs, even though the overall market is down and even though their peers are down. I think this is a pretty strong stock for sure.
Great. And then our last one is VAR.
All right. Varian, that's another medical stock. Again, all of these stocks I just went over are in either real estate, consumer staples, utilities, or within healthcare, some of the areas within healthcare. And these are all more defensive type stocks. And if you look at their charts, you don't really see that huge correction and potential bear market that we see going on in a lot of other areas in the market. But here, this is a medical equipment company. It did make a nice move up. Look at the volume coming in on these two gaps back in October. We pulled back, tested this price support area, and then just broke out again. False breakout. I think the 20 days can continue to hold here. If not that, then gap support. So let's just draw two lines there. So here was the bottom of gap support, and then that 20-day moving average comes in right about there. I would be looking for maybe 117 3/4 up to 119 to hold. The stock was just trading at 127 earlier this week. So again, this is an area that if the money does rotate in and we start to see a little bit of strength in the market, I would be surprised if this stock didn't lead to the upside. I think these are the types of stocks that a lot of folks want to get into when the volatility is so high. So let's go ahead and wrap up these 10 stocks for you. You can see on your screen the 10 stocks that we just covered. And yeah, I mean, I don't know, Mary Ellen, just a off the cuff question for you.
Mm-hmm.
With the market so volatile right now, are you looking more towards those defensive stocks? And we do have a poll running, by the way, which is asking everybody, if we're going to go into a bear market, how this changes your investing strategy. We'd love to hear, if this does materialize into a bear market in 2019, how that's going to change your approach to the market. So my question to you, Mary Ellen, is what do you think? I mean, with everything being so volatile now, are you starting to look more at these?
Yes. So I do. I have a biweekly newsletter, and I also put out intra-week alerts. And on Wednesday, I did note, given the backdrop, the high volatility, to stay away from growth stocks. And for those of you that I work with institutions that are mandated to be fully invested, and it was with an eye towards some of these pharmas, some of these more defensive stocks that you've been pointing out. And from my work, I'm not really intimately familiar with utilities. It's not an area I traffic in. So that's why I was focusing on some of those ETFs so that you can still capitalize, you can get that yield. It's a diversified portfolio. So that would be another way to be in the markets, but certainly not participating in the extreme volatility that we've been experiencing.
All right, fair enough. I mean, I think that's a reasonable way to approach the market right now. All right, let's get into our final market update for the day and see what the market is doing. Obviously, we are still having a rough day. We are off of the earlier lows. You can see the Dow Jones currently down 336 points. We were down more than 400 earlier. The afternoon is what I like to watch, though. I like to see how the market performs in the afternoon, especially heading into a weekend after a non-farm payrolls report. Let's see what the market is willing to do as we go into the close. NASDAQ down 140, the Russell 2000 down 12. It's just not a very good day. 10-year Treasury yield continues just to hover right at about 2.88%. Volatility up from its earlier lows. It is up about 5% on the session. We did go down, looks like just below 20, but we are back down or back up above 22.25 right now. Technology leading to the downside, along with healthcare, discretionary, and industrials. These are all aggressive areas of the market. So we don't really, it's not unusual on a down day to see it, but we've been seeing it over and over and over again, and money continues rotating to safety, and that's a problem. And as I mentioned earlier, here's Alta and Cooper Companies, two of the worst performers in the S&P 500. Both have moved off of earlier lows. I think Alta was down at about 264 when we talked about it. It has had what looks like maybe a false breakout, or breakdown. and recovery, but it's early in the session, so there's still a lot of time left, almost 3 hours left in the day. Cooper has also rallied after testing some support. We'll see if those two can hold. Last thing on this update, I just wanted to point out, this is the sector summary, and you can see that here with the technology moving to the downside, consumer discretionary, healthcare, industrials, and look at the scooter rank. If we just adjust and take a look, you can see technology falling. It wasn't that long ago technology had a scooter rank about 80 or 85, 90, leading the market on the upside. Now we've got utilities, real estate, consumer staples with the highest scooters, and healthcare. So those are the 4 areas. We were just looking at stocks for the 10 and 10. And that's why. I mean, those are the areas where money has rotated. That's where you're going to find some of the strongest looking charts right now. All right, so that is it for our final update. We are going to move into now the final segment. And in this segment, we are going to show how you might consider scanning for shorts. Now, I have said before, and I'll repeat it again, I'm not ready to start shorting just yet, but I know many of you are. And so I'm just going to pull up a scan that I had set up earlier. And that is this particular scan right here. So let's take a look at it. So what I was doing was I wanted to find stocks that had at least an average volume of 200,000 shares. Doesn't matter whether I'm going short or long. I like to have liquidity in a stock. The next thing I wanted to see is an RSI that was greater than 50 and below 60. Now, the reason I do this is that normally in a downtrending stock, when you get a push back up, a lot of times you don't see the RSI go back above 60. So if you've got an RSI somewhere in the 50s, chances are that if the stock starts to move up a little bit from current price, it's probably going to take the RSI with it. You can probably get stopped out of that trade with minimal losses. So that's the whole idea there. Now, if you go down here below and look at these last 3 lines, what I'm trying to do is set up a scenario where I open today below the 20-day EMA. I have a high, intraday high above the 20-day EMA, but then I have a close, which really isn't technically a close. It's current price below the 20-day EMA. Now, first thing I'm going to do is let's go back to that dashboard because I did actually save in one of my scans. This other scan, there were 23 stocks, and I'm going to focus on just a few of these. And after I'm done going through these charts, Mary Ellen,
yeah,
ask you for your opinion on any of them that you think are interesting. Either you agree with me, you could disagree with me. It doesn't really matter.
Sure.
But just give your perspective on some of these stocks. So let me take a look first at AABA. I'm going to sort it by symbol. So AABA. Now, when I look at this chart, I see the gap up recently, but I do see selling, the volume picking back up on the selling. You can see we actually went below the 20 yesterday. Today, we moved up above the 20, but we left that tail up there, and we've moved down below. And when I stretch this chart out, I'm going to go 2 years. Basically, we've been downtrending for a while, and if I annotate, there was a key area of support that was holding for a long time, right at about 67.5. And maybe you go just a little bit below. Here was another low. But you can see on this move back up, that black candle printed almost right at this resistance area is now starting to roll back over again. So I wonder if this wouldn't be a bad time or a good time to maybe think about shorting. And we'll just have to wait to see, I guess, whether or not it can move back up above that 20-day moving average. But again, I think if you go back and we take a look at that on a shorter term chart, you can keep a fairly tight stop, maybe even use today's intraday high, which is only $1 above current price. If it were to break back up above that, maybe take your losses. But if this truly is beginning to roll back over in the direction of that longer term trend that I just showed you, it seems like maybe this 20-day moving average might be a key. So let's take a look at the second one. And this one is COLB. Now, Mary Ellen was talking earlier about the banks. I tend to agree. You look at this, you had a nice uptrend. It was following the 20-day. And then all of a sudden, earlier this week, big move down. And now we're coming back up and failing at that 20-day moving average. This is another one where I'm going to stretch it out a little bit, take a look at the longer term chart. We had kind of a downtrend. This is what I think Mary Ellen also was referring to earlier. Banks were struggling throughout the year. Even though the S&P went up, moved up to new highs, the banks struggled to do that. This one didn't, and it fell apart in August back through October. It made this bounce back up, but now it looks like it might be rolling back over. So COLB is another one I think that could be an interesting candidate. Let's look at the next one, Goodyear Tire. Goodyear Tire on this 6-month chart, again, was holding, looked like it was trending higher. Now, all of a sudden, breaking back down below that 20. And once again, I'm going to stretch it out a couple years so that we can get this longer-term flavor. And we have a downtrending stock. Here was a reaction high. We went to a new low. We set another reaction high, which is lower. It seems to me like this downtrend is still in play, and now we're moving back below that 20-day moving average. Again, if we move back and go back above the 20, we can always get stopped out with a pretty tight stop. But if this is the start of another big drop to the downside, I mean, you can see when it lost its 20-day back in February, how it stayed below the 20-day for quite some time. Is this the start of another drop? I think time will tell. A couple more here. Let's take a look at IRDM. This is Iridium Communications. Now, this one had been looking pretty good. And I think the fact that beginning of the year was trying to make a breakout over this prior high, is this really a good short candidate? Well, on the daily chart, I think that we've got this push back up above the 20 and the failure. But what really sets this one up, I think, for potential short is not just this double top, but look at the weekly PPO. As we made this higher close on a weekly chart, we have a negative divergence, and look at that bearish engulfing candle right at the top. The last time we had off of an uptrend a bearish candle like this was a dark cloud cover. Next 3 or 4 weeks, the stock went from almost $21 down to 17 and change. When I see a negative divergence, I start thinking 50-period moving average, which is all the way down at 16 and change. And of course, we have that prior support at about 17 and change. So this is one that on the daily chart, I would hesitate, but the weekly chart seems to be pointing to more weakness ahead. Last two, let's pull up ORIT. Another financial stock, had a nice move. Again, trading above this rising 20, and then all of a sudden we failed. We're coming back up, testing it from underneath. And if we pull it out to another extension here to 2-year chart, the stock really has gone nowhere the past couple years. And anytime you get a nice rally, it seems like that's a good opportunity to maybe get on board the short side. I think you've got overall resistance 1640, support down about 1370. This is one that doesn't move too wildly over longer periods of time. You can see it's in a pretty tight trading range. But this is one that if it fails at this 20-day moving average and the overall banks and financial in general is weak, I think this is one that could continue moving lower. And then the last one I have is USFD. So USFD, now you look at this and it looked like maybe it was starting to strengthen off of this move to the downside, trended up for a while, and now in just 1 week's time, we've gone back down. We've lost the 20-day. You can see the top came with some volume. It seemed like there's a lot of folks selling from that point moving forward. And another one as we stretch it out here for the past couple years. You will see this one was downtrending on very, very heavy volume back in July. I think we've gotten a bounce. I'm going to annotate very quickly. I have not looked at this yet, but if we use the Fibonacci retracement and go from the low, you can see that we hit that first area of Fibonacci retracement zone resistance, which is at 38.2%. Never quite made it up to the 50% area. And now we're rolling back over. I don't know. I think the volume trends here were really weak on the move down. And now you're starting to roll back over. Not liking this one either, Mary Ellen. What do you think of these 6 I gave? You have any comments on these?
Yeah, sure. I don't know. Should I take the screen or just?
Yeah, sure. Yep, take the screen.
Okay. Yeah. So there were a couple of them that I certainly agree with you on. And then We can go ahead and take a look at that last one, that USFD, just to get us into the game, so to speak. You can see this. This is a daily price chart. I've overlaid the RSI and the MACD. This big gap down was earnings related. The stock suffered with the broader markets, attempted to reverse. But with this more recent decline, first of all, it found resistance potentially at this 200-day. Your RSI is trending down. Now you're getting that negative crossover on your MACD, which could be poised to go lower. So this certainly looks like a candidate. There was comments that I wanted to make on not GE, GT, and that was the third name in Goodyear Tire. So let's take a look at this particular stock. This has been in a super downtrend, but what I did want to mention is that analysts' outlook for 2019 is that the stock is going to reverse and do well, and that has everything to do with the fact that Goodyear Tire, their production of their products is based on the price of oil. So they have really been hit hard, certainly over the last 2 years. We can take a look at a weekly chart with Goodyear Tire going back to, let's drill down a little here, 2017 into 2018. We started hitting a $65 per barrel price. It did get up as high as 80. Goodyear Tire can make a profit if the price of oil is 50 or below, is what analysts are saying. And we are certainly in that range now. So if we do continue to see oil prices remaining depressed or below or around this $50 level, we could see Goodyear Tire reverse from here, and analysts are raising estimates for next year. What I would need to see is the price to break back above this downward trending 200-day simple moving average, and then in turn that would pull these other simple moving averages up. We're not quite there yet. It's something to keep an eye on. I think investors will need to see a stabilization in that price of oil because it has a very, very steep downtrend that's needed to be reversed. So I'm arguing that it will take time, but if we do see oil prices lower, we could see GT go up. COLV is another one I thought I'd just provide a little further insight to your insights, Tom. And for my work, when I'm looking at stocks, I like to look at history to see. So here, as far as when you're looking to short a stock, what are the behavioral characteristics when that particular stock or any stock enters into a downtrend? And that would take us back to the late August, September period here. I have the RSI displayed up above the price, and what we can see here in conjunction with the price breaking down below, the blue is your 200, the green is your 10, and the red is your 50-day simple moving average. So in conjunction with a break below these key simple moving averages, which normally should be acting as support, we break below that. That is coinciding with an RSI that's trending negatively. Down below, we have this MACD, the black line down through the red, and then it goes and dips below zero. So we have three signals flashing simultaneously that the stock is very well going into a downtrend. It does just that. So now we have this downtrend potential reversal. It's the opposite, the MACD up, the RSI up, and it's breaking back up above these key simple moving average. Doesn't mean I love it here, but we do still have the RSI just treading above that net neutral. Your MACD had a negative crossover, but it is above this zero line. So not as negative, certainly as if you were to look at it historically back in that period. If I have time to take a look at one of the other names that we reviewed as short candidates, IRDM. And this is another one that I did want to point out, Iridium Communications. So you want to look at these other technical indicators from my work. The RSI is still up here in positive territory. We've had that negative MACD crossover, but it is still above that net zero. So certainly depending on the broader markets, I like to look at stocks. For instance, the broader markets are getting hit hard today. This stock is down 0.9%. So in essence, resisting or not succumbing to the downside pressure in the broader markets. So I would not be quite as negative on this. I don't love it, But on the weekly, your RSI is further in positive territory, and your MACD is above the 0. So those were insights a little beyond your work, Tom.
No, I mean, I think that's great information. No doubt. Yeah, the IRDM bothers me a little bit just because I don't like shorting healthy stocks. And I think that that chart is clearly strong relative to what the market's been doing in 2018. But sometimes they do get ahead of themselves. And it looks like we got a double top there, and possibly with a negative divergence on the weekly chart. Maybe we're just going to see a little bit of sideways consolidation that might take it down another couple bucks. But that's really what I'd be looking for in terms of that one. It did set up a little differently than some of the others. But let's go ahead and pull up that poll, and because I'm interested in seeing how everyone else views a bear market and what that means to them in terms of taking a look at things. So first is our scanning for shorts. Those were the stocks that Mary Ellen and I covered. And if we can go ahead and pull that poll up, we'll take a look and see how everybody else responds. I'll say this: when the market is in a bear market, for me, once I'm convinced, and that's going to take a breakdown on the S&P below that February low, I think once that happens, what I do is exactly the opposite of what I do in a bull market. I wait for a bounce in a bear market and I short. And then when we get too oversold to the downside, and the fear picks up and we get up too high on the VIX, then I take profits, and then I just rinse and repeat. I just wait for that, that pattern to continue to come through. Okay, so here are our poll results. So the winner is considering a mixture of cash and investments. Only 20% switch from trading longs to trading shorts. That's interesting. I'm going to guess that that's probably double or even triple what it would have been 10 or 15 years ago. I think more and more people probably are familiar with shorting and what it means. But anyway, 17% not sure, 11% using hedging strategies, 10% moving entirely to cash, and 6% do not shift their strategy at all. Interesting. Yeah, I would definitely say for me, it's moving. I completely switch from trading longs to trading shorts. So I would go into that 20% category.
And there's always the possibility of those inverse ETFs where you are, instead of long, they are shorts, sometimes triple shorts.
Yep.
Is another option.
I'm not that crazy.
I still work with a couple of hedge funds, and they'll often joke, because they can short the markets, that they have two ways that they can lose money, long and short.
That's pretty funny. Yeah, I heard a joke one time said, do you want to make, to make $1 million in the stock market, or you want to have $1 million in the stock market? And I said, yeah, well, how do I do that? He said, start with 2 million. It's true when you get into a bear market. It's it's been in a bear market and been hurt in a bear market knows exactly what I'm talking about, because a bear market,
you bet,
you can lose value quite a bit, pretty quickly. But thanks, Mary Ellen, for joining me again. You'll be back next Friday. Can't wait to see you again.
You bet. Yeah.
All right, that is it. It is a wrap for us today. I want to thank everybody for being with us. Please remember to complete that survey as you exit. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Friday afternoon, everybody. Enjoy your weekend. Be safe out there, and we'll see you back on Monday. Happy trading.